If you're tired of complicated trading strategies that never work in real markets, this video is for you. Today, I'm going to teach you a simple, powerful trading strategy that even beginners can use, and you can start applying it immediately after watching this video. You don't need any indicators. You don't need a big trading account. All you need is a clean chart, discipline, and the step-by-step method I'm about to show you. This strategy is based on how smart money really trades, not retail tricks. And once you understand it, you'll never look at the market the same way again. Before we continue, here's what you're going to learn in this video. A high win rate day trading strategy used by smart money, the sweep and flip protocol, a simple but powerful entry model, a trading system you can use on Forex, crypto, indices, stocks, and metals. How to spot liquidity traps and avoid being manipulated by institutions, exact entry rules, stop-loss placement, and take-profit logic. A complete trading plan you can start applying today even as a beginner. Real chart examples with clean execution so you understand everything. And most importantly, the top mistakes traders make that destroy their results and how to avoid them. Before we get started, make sure to like this video, subscribe to the channel, and turn on the notification bell so you never miss future strategy videos like this. Let's begin with the foundation, understanding how institutional trading algorithms operate. Institutions don't enter the market the same way retail traders do. They rely on advanced algorithms engineered to track a single core element in the market, liquidity. Liquidity simply refers to clusters of stop losses and pending orders waiting to be triggered. The majority of retail traders place their stop losses under support levels or above resistance zones, and that's precisely where smart money focuses its attention. Once liquidity builds up in a specific zone, institutional algorithms launch a sudden move, a fake breakout or aggressive wick, designed to sweep stop losses. When those stops get triggered, they convert into market orders, giving institutions clean entries at the best price, without dealing with slippage. But institutions aren't trading the breakout itself. They use that engineered spike as an opportunity to position themselves in the opposite direction. That's why, immediately after a liquidity grab, price often snaps back aggressively. Retail traders get trapped and shaken out, while smart money is already positioned in the winning direction. That's the real game behind price movement. The market hunts liquidity first. It doesn't care about your setup or indicators. If you don't recognize this, you're not trading the market, you're simply providing your stop loss as someone else's entry. For institutional algorithms to execute effectively, the market must first be prepared in a specific way. And that's exactly where the three-phase playbook comes into action. Load liquidity. This is the accumulation stage. Price consolidates in a tight range, nothing dramatic, just quiet movement. But beneath that calm surface, liquidity is being gathered. Retail traders stack stop losses below the range, while breakout traders place buy stops above it. Little by little, liquidity builds on both sides, creating the perfect setup for a trap. Trigger the trap. Now comes the manipulation stage. A sudden aggressive move breaks out of the range, sweeping liquidity. Retail traders believe it's a genuine breakout. Some jump in late, chasing the move, others get stopped out instantly. But none of this is the true move. This is the trap being set. Execute the real move. Once liquidity is collected, institutions enter with full volume, in the opposite direction of the trap. This is the true move, the one backed by institutional flow. Price now moves cleanly and decisively, leaving retail traders behind. While most are trapped or trying to revenge trade, smart money is already in, riding the move they engineered. This pattern doesn't happen by accident. It repeats, week after week, and in some markets even multiple times per day. Once you train your eyes to recognize it, you'll start spotting it everywhere on the charts. Now that you understand how institutions engineer traps in the market, it's time to reverse roles and position yourself with them, not against them. The strategy I'm about to reveal is called the sweep and flip protocol. Its goal is to catch the true move, the one that comes after the liquidity sweep. Exactly where institutional money flows in and retail traders get caught off guard. But precision matters here. Timing and structure are the key to making this work consistently. This setup isn't something you trade randomly throughout the day. It only works during a precise timing window, near the end of the Asian session and into the London Open, when liquidity floods the market and institutional traps are most often triggered. To follow this strategy, you'll only need one clean free indicator just to mark trading sessions clearly on your chart without clutter. We execute the setup on the 15-minute time frame. That's where we find our entries. But before we take any trade, we always start with a quick top-down check on the 1-hour chart to confirm the institutional direction and stay aligned with smart money flow. Here's how it works step by step. On the chart, we first identify the Asian session, followed by the London session. We'll use a simple free indicator to highlight both. Our analysis begins near the end of the Asian session. At that point, we mark the most recent high and most recent low. This range represents the accumulation phase. Then we wait for the London session to open, because that's when volatility kicks in and the real play begins. Right before the true move, we expect a liquidity sweep. This is when institutional algorithms search for stop-loss clusters sitting above the highs and below the lows. And that's exactly what we want to spot. Here's what we see on the chart. Price pushes above the most recent high, clears liquidity, then immediately snaps back below the level. This is a textbook liquidity grab, a deliberate trap designed to lure breakout traders in the wrong direction before reversing the move. You'll see this pattern appear over and over again, but it's most reliable when it happens during the London session, because that's when institutional algorithms actively hunt retail liquidity before launching the real move. Once you identify this setup, your execution is simple. Enter a sell position as soon as the reversal candle closes. Place your stop loss just above the liquidity sweep. Set your take profit at the most recent low. That's your bearish sweep and flip protocol in action. Now let's break down the bullish scenario. Just like before, we start at the end of the Asian session and mark the most recent high and low. These levels form our accumulation range. For institutional algorithms, these aren't just price levels, they're liquidity pockets packed with stop losses and pending orders, which is exactly what smart money targets. Here's the typical sequence. Price dips below the recent low, sweeps liquidity, and then sharply reverses back above the level. That's your confirmation to enter. Open a buy position when the candle closes back above the level. Place your stop loss just below the liquidity sweep. Aim for the next major structure level as your target. This gives you a precision entry, perfectly aligned with institutional flow. But this is only the execution part of the strategy. Next, I'll show you how to apply a fast top-down analysis to filter your setups, so you don't take random sweeps, you only take the ones backed by strong directional bias and smart money structure. Now, let's walk through a real example on the Australian dollar Canadian dollar 15-minute chart. Before we begin, we'll set up our session indicator on TradingView for clear visibility. Head over to the Indicators menu at the top of the screen and search for Sessions in the search bar. The one we'll be using is called Sessions by JRFX Addict. Click to add it to your chart. If you're using a dark background like I am, the sessions might not stand out clearly at first, so let's adjust the settings for better clarity. Hover over the indicator name at the top of your chart and click the settings icon. Then open the Style tab. Here are the settings I recommend. Uncheck the New York session to remove unnecessary shading. Set the Asian session color to red. Set the London session color to green. Now your chart is clean and easy to read. You'll clearly see when the Asian session ends and when the London session begins, which is exactly what we need for this strategy. Now let's apply the strategy step by step. Here we have the end of the Asian session, and the London session is about to open in 15 minutes, at 8 a.m. London time. Our first step is to mark the most recent high and most recent low of the Asian range. Now watch what price does when London opens. It dips below the recent low, sweeps liquidity, then snaps back and closes above the level. That's a textbook liquidity sweep, classic institutional behavior during the London session. They trigger a fake move to trap retail breakout traders, then immediately reverse into the true direction. But now that you understand how this works, you're no longer falling for the trap. You're trading with smart money. Before executing any trade, we begin with a quick top-down analysis. Even though the entry setup is on the 15-minute chart, we first confirm market direction using the 1-hour time frame. So let's switch to the 1-hour chart and temporarily hide the session indicator for a cleaner view. Here we can clearly see that price is in an overall uptrend and has recently pulled back into a previous resistance level that is now acting as support. A strong bullish rejection candle has formed at this level, showing signs that buyers are stepping back in and the uptrend may continue. This gives us bullish bias from the 1-hour chart, which perfectly aligns with our liquidity sweep setup on the 15-minute chart. Now we return to the 15-minute chart to execute. We take the entry as soon as the candle closes back above the swept low. our stop loss goes just below the liquidity sweep, and our take profit is placed at the next significant resistance level, always targeting a minimum 2-to-1 risk-to-reward ratio. And as you can see, price moved smoothly in our direction and hit the target with precision, exactly as planned. Let's take another example, again on the US dollar, Swiss franc 15-minute time frame. We start by marking the most recent high and low of the Asian range. That defines our accumulation zone, where retail orders begin stacking up. Now watch what happens as the London session opens. Price shoots above the recent high, but then instantly rejects and closes aggressively back below the level. That's a perfect liquidity sweep, a fake breakout engineered to trigger stop losses before the true move begins. That sharp spike? That's not the institutional move, that's the trap, the liquidity grab. The real move only begins after the sweep, once price flips direction. But before taking any entry, we confirm direction with a quick top-down analysis. Switching to the 1-hour time frame, we can see that the market is currently ranging. Price has recently rejected a key resistance area and is now moving lower toward a major demand zone. This tells us there's still bearish pressure in the market, which aligns perfectly with our short setup on the 15-minute chart. Now we return to the 15-minute chart to execute the setup. Enter the trade at the close of the bearish candle that flips back below the swept high. Place the stop loss just above the liquidity grab. Set the take profit at the next key support level. This setup gives us a minimum 2-to-1 risk-to-reward ratio, which is exactly what fits our rules. And as you can see, price dropped cleanly and hit our target. No drawdown, no stress. Now I want you to understand something very important. Even if you know this strategy perfectly, if you make certain mistakes, nothing will work. You can have the best strategy in the world, but one small mistake can completely destroy your results. So let's break down the first and most common mistake traders make, ignoring the higher time frame. This is a deadly mistake, and it's the reason traders blow accounts even when they think they found a perfect entry. Let me show you what I mean. Here we are on the Australian dollar, Canadian dollar 15-minute chart. The market is trending down, so everything seems normal. This is the most recent Asian session high, and this is the most recent Asian session low. Then we get this. Price breaks above the recent high, sweeps liquidity, and closes back below. That looks like a perfect bearish sweep and flip entry, right? So what happens next? Most traders would jump in immediately. They sell at the candle close. They place their stop loss above the sweep, and they aim for the next level. But look what happens next. Price reverses and hits the stop loss. At this moment, most traders get frustrated. They start thinking, why did this lose? The setup was perfect. The strategy doesn't work. Maybe I should change indicators again. No, the problem is not the strategy. The problem is that you ignored the bigger picture. Now let's fix it the smart way. Before taking any trade, we must do a quick top-down confirmation. That means jumping to the 1-hour chart to check the real direction of smart money. Now look at this. On the 1-hour time frame, the market is clearly in a downtrend. Price also formed a double bottom, which is a bullish reversal pattern. And here's the biggest clue. There was a liquidity sweep at a key support zone, trapping sellers and loading buy positions. This means institutions were accumulating long positions, so when you took that sell on the 15-minute chart, you were trading against the real direction of the market. That's why it failed. You can't trade the sweep and flip strategy blindly on the 15-minute chart. If the higher time frame says the opposite, your trade will most likely fail. And it doesn't matter how perfect the setup looks. Your entry time frame gives you precision, but the higher time frame gives you direction. If you ignore direction, you will lose. Every time. This one mistake alone is enough to blow your account over time. Why? Because you keep taking high probability setups, but in the wrong direction. The second mistake is trading without a minimum 2-to-1 reward to risk ratio. This is one of the biggest reasons traders lose money with this strategy, even when they use it correctly. The sweep and flip protocol is a sniper strategy. It gives clean entries, but if you ignore the reward to risk ratio, you will destroy your results over time. Let me show you exactly what I mean. Here we are on the US dollar, Swiss franc 15-minute chart. During the Asian session, the market was trending down, and once London opened, we spotted a clean liquidity sweep below the most recent low. a perfect bullish sweep and flip setup. So we mark our entry at the close of the reversal candle. Everything looks good so far, but here's where most traders go wrong. They place their take profit too close, giving the trade only a 1-to-1 reward to risk ratio. This is a trap. Sure, you might win this trade, but you will lose long term. Why? Because trading is not a sprint, it's a marathon. A 1-to-1 reward to risk ratio means that one losing trade cancels one winning trade. With spreads, commissions, and slippage, you're actually losing money slowly without realizing it. That's why professional traders never accept low reward to risk setups. Now watch what happens when we do it the right way. Instead of taking a small, weak target, we extend our take profit to the next strong resistance level. Now the trade gives us a 3.4-to-1 reward to risk ratio, meaning for every $1 we risk, we aim to make $3.40. This is how professional traders think. Small risk, big reward. That's how you grow consistently, even with a normal win rate. Now look at what happened next. Price exploded in our direction, hit the 3.4 reward target easily, and continued moving higher. The setup didn't just work, it paid out 3 times more because the target placement was smart. So remember, never trade a sweep and flip setup with less than a 2-to-1 reward to risk ratio. Follow the rules and this strategy will work for you. Ignore them and the market will punish you. I hope this breakdown gave you real clarity on how to use this strategy with confidence. If you found value in this video, hit the like button, subscribe, and turn on the notification bell so you don't miss the next strategy video. Thanks for watching, and I'll see you in the next one.